Good morning, students. Today we're going to look at market ratios and we're going to review the profitability ratios from last Friday. Let's go to your Wolf Den, see what you need to have pulled up. Okay. Now I've pulled up the PowerPoint slides. Let me minimize them. This is what we're going to review starting at slide 20, looks like 23. Okay. Those are found under Test 2 material, Chapter 3, Part 2. You need your ratios. I think my husband made some of you copies. So you need to pull up your ratio page that looks like this and scroll on down to the second page. Okay, where is it? There we go. Okay, we'll be looking specifically at these market ratios, which are the last three, but I want to review the ones that were done in class, starting with the gross profit margin. And then you also should have completed those for homework with Apple. Okay, you want your Bartlett financial statements. My husband gave you a copy of those in class. If you missed, you need to make sure you print you out a copy. Okay, both the income statement and the balance sheet. They're both here. For homework, you will need your Apple financials. And then we also have been looking at benchmarks, which are a measuring tool that you want to do a comparison. We'll compare the net profit margin, return on assets, and return on equity there. Okay, so let's take a look at the PowerPoints. And I want to review these, first of all, these first three profitability ratios. He did go over them. Here are the formulas. So let's come down to the handout that he looked at in class and where these numbers came from. Gross profit margin in class, he put this on the board. That would be your sales minus your cost of goods sold equals your gross profit or gross margin. Let's take a look at Bartlett. We're going to divide that by sales, and that gives you 32. Okay, this means that for every $1 in sales, we are generating 32 cents in gross profit, or you can refer to it as a percentage, saying that 32% of your sales represents gross profit. Now, what is gross profit? Let's take a look at your income statement for Bartlett. Sales, top number, cost of goods sold is what you pay to sell that product. Like if you have the bottled water that I've mentioned in class several times, Walmart sells it for about $1.50. The cost to buy that water is about 25 cents. So they make a good profit, a gross profit margin of about $1.25 on their bottled water. Okay, this number is the gross amount before subtracting out operating expenses such as selling and advertising and that sort of thing. We have a lease expense, we have depreciation. Total operating expenses would be represented here. So the next line is your operating profits. Now I've told you that that is also called earnings before interest and taxes. Earnings before interest and taxes. So I want you to remember that, because the next ratio is your operating profit margin. And it's taking that number after you've subtracted out your operating expenses and dividing it by your sales. So it should be lower than the one before. Let's go back and take a look at your numbers. So in this case, you're looking at 418, and you want to divide that by sales, 3074. Here we get 14 cents on a dollar, or 14%. That means that for every $1 of sales, we have about 14 cents after we've paid most of our expenses in profit. That doesn't sound like much, but when you multiply that times numerous volumes of sales, it adds up. So it could also be expressed as a percentage. 14% of sales represents your operating profit or your earnings before interest and taxes. Now listen to that, earnings before interest and taxes. So the only two expenses now that have to be subtracted out to get to net income will be interest and taxes. Okay, so come back, and your next line here is your interest expense. That gives you net profit before taxes. Now, interest is what you pay your bank for borrowing money. And the next line is going to be the amount of taxes that you've paid. And so net profit after taxes, this would be net income were it not for the fact that you're subtracting out dividends. Okay, so this is actually your net income. Okay, so let's come over and take a look at net profit margin, which is going to be your, in this case, it says earnings available to common stockholders. Now, that's going to be your net income minus dividends. So take a look at this number. Net income minus your dividends will be the bottom line here, 221. So you want to make sure you've subtracted out your, in this case, preferred stock dividend. So we have here, the number is going to be 221 divided by sales of 3074. All of these denominators are sales. So here you go, 221 divided by sales. Now this number should be very low, lower than the other two. This means that for every $1 of sales, you're generating 7 cents on a dollar. Okay, 7 cents for every $1 of sales, or 7%. You could express this as a percentage by moving your decimal place 2 places to the right. 7% of sales is represented as net income, basically. Okay, so the higher the better, and what you'd normally want to do is compare those. So let's take a look and see if we have any benchmarks. Okay, net profit margin here. Notice that 2.7%, 6.7%, 3.1%. So these are this one in particular is in the range of the one we have, which is 7%. But most of them are lower than the number that we have. Okay, so in this case, this was Hewlett-Packard, almost 7%. So we're doing pretty good as a fastener company. Okay, let's take a look at the other ratios that you have. You have your return, earnings per share, and this is just a measure of what our shareholders can look at as far as the earnings that have been acquired by the company for every 1 share of stock. It has nothing to do with whether or not we're going to give them that in dividends. So look at the formula. Earnings available to common stockholders. Okay, that's going to be your bottom line. That's going to be net income. So come down here. Make sure you've subtracted out of your preferred stock dividend. So 221. Okay, now if we didn't have any stock dividend to preferred, it would be this number up here, 231. But we want to go to the bottom line. That's what's available to common stockholders, and divide that by the number of shares outstanding. Now, where are you going to find that? Well, my husband should have shown you that you go over here to your balance sheet, and if you notice where it says common stock, these are the shares that have been sold. Okay, these are the shares that have been sold. 76,262 is going to be your denominator here. Now, notice when you put it in your formula, though, in order for it to work properly, you have to add the zeros here. Okay, so we have our zeros added, meaning that we have a dollar amount of $2.89 per share. That means that if you own 1 share of stock, the earnings for that stock this period, $2.89. It does not mean that's what we're going to give you for a dividend. It would be much, much less than that. It does not mean that that's what your stock will sell for. It's just a measure of what the company's done as far as being profitable. Okay, we have 2 more measures here. We have a return on assets. In other words, for all the assets that we have, what kind of net income, remember this would be net income if you didn't have preferred, what kind of net income have we been generating using the assets that we have? So coming back to the bottom line number here, 221, bottom line, and we want to divide that by our total assets. So go to your balance sheet, total assets, 3597. Now let's take a look at this number. Okay, I calculated it, 221, 3597. We come out with 0.06, which is 6 cents on a dollar of assets. So for every $1 of assets we've been using, our equipment and everything, building, we're generating about 6 cents in net income. Or 6% of all of our assets are generating net income. 6% is the generation percentage. Okay? Okay, let's take a look as far as what our stock equity return is. So taking a look at all the stock that we have sold, as far as common, not preferred, how's that working for us? How's that generating net income? So again, notice that your numerator is going to be net income. Bottom line on your financial statement, income statement here. Take a look. 221. And we want to divide that by our stockholders' equity, common stockholders' equity. Now, take a look at your balance sheet. Okay, everything starting with preferred stock on down to total stockholders' equity here. That's your equity statement. Okay, the rest of this is your liabilities, and above that's your assets. Now, if you take this bottom line, 1954, you have to subtract out your preferred stock because we only want to look at what's used for common. So 1954 minus your 200 in preferred stock gives you 1754 as your denominator here. So plug that into your number. 221 is net income divided by 1754, which is common stockholders' equity. Means that as far as stock sales go, for every $1 that we've sold in stock, we're generating about 12.5 cents. 0.125 is 12.5 cents. Okay. So if you converted that to a percentage, that would be 12.5% here. Okay, so you know, actually we're using our equity better than we are our assets. Okay, not too bad as far as generating income. Okay. Now the last three are the ones I want to look at today. So your market ratios are the ones we want to focus on today. And let's take a look at the blank form. My computer went off, so I have to pull that up again. So let's take a look at the blank. We're looking at the last three ratios, and I'm going to actually work them out for you. This is going to be a measure of how our stock is doing out in the marketplace. Okay, a measure of how our stock is doing out in the marketplace. So our price-earnings ratio, this is one that is very, very important to our investors. Okay, very important to our investors. They like this ratio. The first number as your numerator has to be one that's given to you. This is not one that's anywhere in the statements. $32.25 is what the stock is currently selling for. You would find that in the Wall Street Journal, but in our case, I have to give you that number. So this is a given number. You cannot find it in the financial statements. Now, dividing by earnings per share. So let's go all the way back up to number 14. Okay, 14. And if you remember, our earnings per share on number 14 was $2.89. So take that and divide into this market price per share. That's going to give you $11.10. Okay, $11.10, and this is going to be expressed as a dollar here. Now, what that means is for every $1 in earnings per share, the selling price on the market is around $11, and that's good. The higher, the better. Okay, so this is a measure of what's going on out in the marketplace. This is how investors look at our stock. Now, let's take a look at the next ratio, which is a ratio called the book value per share. Now, this particular ratio is only used for the last one. So it's not a measure that really means a whole lot. Let's take a look at where we get the numbers. Market price per share. Let's see, I'm sorry, right here. Book value per share is your common stockholders' equity. So let's go back to your balance sheet. Back to your balance sheet. Take a look at your numbers here. Remember, all of this down from preferred stock all the way to stockholders' equity represents your owner's equity. That's 1954. But in order to use this number, you have to subtract out your preferred stock, 200, and that would give you 1754. So that's going to be your numerator. And we want to divide that. Now, we're going to divide it by numbers of shares of stock. The only way this will work is if we put the 3 zeros behind it. So anytime you're dividing by number of shares of stock, you have to add your 3 zeros. You can't truncate it. Okay, let's divide that by the number of shares of common stock, which is found on your balance sheet over here. 76262. 76262. Now, dividing that through, that gives you $23 book value per share. What that means is that for one share of stock that you have, the value on our books is $23. Value on our books is $23. Investors don't put a lot to do with that. Okay, they're not really that hyped about that number other than to use it in your next number. Okay, so let's take this number, and if you'll notice, that will be your denominator. So $23 will be your denominator in the market book ratio, and the market price per share was $32.25. That's given. You would get that from the current financial information that's showing on the Wall Street Journal. When you divide that, you end up with $1.40. Okay, this is what investors will pay for $1 in book value. And so if it's above 1, you're in good shape. They'll pay you over what's on the books. That's what it means. They will pay you above what you're showing on your books for your stock. Okay. Now, let's go back to your PowerPoints and just show you where these numbers can be found. On slide 30, you have your price earnings ratio, your book value, and your market book value. Okay, those are the three that we just did for the market ratios. You need to go back and review all this information. This tells you a little bit more. Basically, what I just said gives you the answers. Okay. This slide is another measure of benchmarks, and they also summarize all of these ratios that we have done. Okay, they summarize everything that we've done. And then the last slide is what you need to complete everything. You will need to know what the current, as of 2013, the market price of the share of Apple stock was $483. If we did this today, it's around 100 something, so it would be quite a bit lower. You do need to know the outstanding shares at that time, which is the last number, 899213. Earnings per share for Apple is on the income statements. Let's see. I'm looking. Okay, let me show you where that is. Earnings per share. Come to your Apple statements. You need to get those. Earnings per share, you want to do $40.03. You want to use the basic earnings per share there, $40.03. Okay. Anyway, take these numbers, and what I want you to do is I want you to do the calculations for Apple for these three ratios, and hang on to those. I'll get back with you Wednesday and let you know more about what we need to do. Okay? Take care. Bye-bye.